Hello, good afternoon to all of you. At the outset, on my behalf and on behalf of Infomerics Rating, I'd once again like to welcome you all to this discussion on the Reserve Bank of India's October monetary policy. At Infomerics, we are gratified by the kind of response we have received across institutions, across banks, academia, central banks, and even multilateral institutions. We have also received excellent feedback from different parts of the country. This has encouraged us to carry forward this information dissemination exercise, this analysis of important contextual issues. Carrying forward this series, we today have a discussion on the Reserve Bank of India's October monetary policy. This policy, as most of you will be aware, has evoked considerable debates and discussion in the context of the widespread stagnation. Some have also called it some kind of a stagflationary impulse in the Indian economy. Of late, the Indian economy's position is characterized by what is called the steady deterioration from a twin balance sheet problem to a four balance sheet problem. To place this issue in a proper perspective, I would like to bring to your notice that Professor Arvind Subramaniam, when he was the Chief Economic Advisor of the Government of India, he wrote an important chapter for the Government of India Ministry of Finance Economic Survey. Some of you may be aware that the Economic Survey of the Ministry of Finance of the Government of India is the most authoritative document and has been so for the last 40-50 years. Economic Survey is placed on the floor of Parliament on the day preceding the presentation of the Union Budget by the Honourable Finance Minister on the floor of the Parliament. So this has some kind of a sanctity which few other economic documents, policy papers have. About 7-8 years back, Professor Arvind Subramaniam highlighted the concept of what he called twin balance sheet problem. By twin balance sheet problem, he meant that banks were saddled with high and mounting levels of bad loans, popularly called non-performing assets, and the balance sheet of the companies to which banks were lending was also highly leveraged. In some cases, banks had lent heavily to infrastructure projects. So this was characterized by Professor Arvind Subramaniam, the then Chief Economic Advisor of the Government of India, as the twin balance sheet problems. The situation has taken a turn for the worse in the last few years. And now Professor Subramaniam has gone back to the US, but last year he presented an important paper at the University of Harvard in the US. Most of us would be aware that the University of Harvard in the US is widely considered to be the Mecca and the Medina, one of the highest institutions in the field of academics. Now what Professor Subramaniam does in his paper presented at the University of Harvard last year is that he expanded his concept of twin balance sheet to what he subsequently characterized as the four balance sheet problems. Apart from the position of banks, leveraged companies, he also added the disarray in the real estate sector and the problems in the shadow banking system of India, what is popularly known as NBFCs, non-banking financial companies. the weak financial position of NBFCs in India has evoked considerable debates and discussion, particularly since the collapse of ILFS about 2-3 years back. So this is the context in which we are looking at. For balance sheet problems, earlier we were undergoing a process of macroeconomic stagnation, and now we are definitely in a process of contraction, shrinkage of the GDP. Assessments vary, but then there seems to be a wide-ranging consensus that this year we may end with a contraction in GDP, something of the order of about 8 to 10, 11%. Now let me come to the policy backdrop. What were the challenges confronting the MPC, Monetary Policy Committee, and the Reserve Bank of India in formulating this policy? If I refer to some important global institutions, multilateral institutions like the IMF, which placed its report on the global economy recently, it forecasted that the GDP would contract by 4.4% in this year, while India could contract by the figure of 10.3%. Apart from this contraction across the development spectrum, across developed countries, emerging market countries, the IMF's Global Economy Report also highlighted that the global scenario continues to be distinctly, prospects for global growth continue to be uncertain and unevenness. If we look at the position in India, we find that the first quarter numbers which are out, that there has been a contraction of 23.9% in April-June, and this by most indications is the most severe contraction in the last 40 years or so. There has also been an 8% contraction in industrial production in August, and this year, as I said earlier also, we may end with a GDP shrinkage contraction of something in the region of 8 to 10%. What causes concern is that there continues to be a spike in COVID-19 cases, and businesses across the country, across regions, across sectors and segments of the Indian economy continue to limp. There are obviously the larger issues of disrupted supply chains, demand destruction on a large level, free fall in investment, debilitated consumption demand, low corporate credit, job losses and salary cuts across the board. The position of Indian economy today is characterized by a certain element of contradictory signals. I am reminded of a common analogy that maybe if you have a glass with some water in it, you could be justified in saying that the glass is half full, but someone else looking at that glass may also say that the glass is half empty. Maybe there is a merit in both the perceptions, and the position of Indian economy today has some positive features, some not so positive features. Among the positive features, obviously one of the most important striking factors is that this year food grain production is likely to reach a record high level. There are emerging green shoots in power consumption, rising petrol use, moderating diesel decline, spike in repayments fueled by UPI, IMS. There has also been a significant rise in terms of collections through e-way bill and toll collection, railway freight, passenger car sales, manufacturing PMI, exports, aviation and GST collections. All of them show a clear uptick. I would also like to briefly refer to the Department of Economic Affairs, Ministry of Finance monthly report The September report reveals steadily improved high frequency indicators in the sense that there was 5.3% export growth, recovery in railway freight together with rural demand growth, reflected in registration of two-wheelers and three-wheelers, passenger vehicles and tractor sales. The September GST numbers also appear to be quite comforting in the context of the kind of devastating, crippling hit to the Indian economy by this medical economic emergency of COVID-19 and the September figures of GST at 95,000 crores together with rise in fertilizer sales, manufacturing, PMI, Purchasing Managers Index, peak power consumption, all these are welcome aspects of the evolving Indian growth story. Apart from these factors, there are several other positive indicators such as negative interest rates in major markets globally, huge forex reserves which keep surging from one peak to another, ample liquidity in the banking and the financial sector, and surging foreign direct investment. With the festival season approaching, it's widely expected that this could gain further traction. But the position of non-gold imports, credit deposit ratio, new capacity expansion, capex, hotels, restaurants, tourism, FMCG, fast-moving consumer goods, etc. Here what we find is that the growth is not yet quite broad-based. There are also some issues which are quite disconcerting in the sense of higher unemployment rate, stress debt, conspicuous absence of investment cycle in corporate credit, consumption income faltering, and weak balance sheet of banks. Now, most of us are aware of the significant contribution of the services sector to the broader Indian economy. The services sector, as most of you would be aware, contributes about 55% of the gross domestic product and one-third employment. Now, this in terms of the IHS PMI rose from 41.8% in August to 49.8 in September. So this rise of up to 49.8 in September is remarkable because 50 is usually taken as the threshold level. So by and large, it could be seen that things have certainly gaining traction. I would also like to draw attention to one other aspect of the Indian economy. Historically, the Indian economy has always faced a balance of payments problem, a balance of payments deficit. But in this COVID-19, we have witnessed some kind of a deviation from what had become a defining feature of the Indian economy. As I look at it, they are both short-term factors and relatively longer structural factors. Among the short-term factors, we may mention surge in foreign currency reserves, sluggish imports triggered by severe macroeconomic contraction, and rise in exports because of fiscal stimuli in the developed world and a rapid output revival in China. Among the structural factors at play here, mention may be made of low energy prices, thrust on Atmanirbhar Bharat, and the concerted attempt to move up the global export value chains. In this kind of a new normal, people in India have shown dynamism and resilience and increasingly shifted to the digital products across banks, across financial systems, across educational institutions, in almost all spheres of life and economic activity. There are aspects like disruptive demonetization, rolling out of the GST, goods and services tax, COVID-19 influences, commonplace smartphones, e-wallets, UPI technology. All these have facilitated financial technology startups onboard and integration. This is particularly welcome because in this kind of an evolving scenario, digitization is the way to go for the Indian banking. If we look at the banking system today, there are issues of modest capital buffers for most public sector banks. NPA levels continue to mount, higher credit cost and weaker earnings because of interest reversal and low fee income and subdued growth prospects. One important aspect of deposits and advances which I'd like to highlight is that in this kind of a stressed economic environment, in this kind of a stress in the banking system, bank deposits have surged to rupees 143 lakh crore. And the striking part here is that there has been a rise post-March of the order of rupees 6.8 lakh crore. Advances, however, fell post-March by 1.4 lakh crore to 102 lakh crore. This widened gap of about rupees 8.2 lakh crore has been met by increased government securities investment. This is suggestive of what Dr. Rakesh Mohan once characterized as lazy banking. Now, in this overarching economic and banking context, the MPC, Monetary Policy Committee, unanimously decided to keep the policy rate under the LF liquidity adjustment unchanged at 4%, and consequently the reverse repo under the LF remained unchanged at 3.35%, and the MSF rate, bank rate, also remained unchanged at 4.25%. The RBI continued with its accommodative stance despite some growth and inflation context. In this situation, post-March, if we look at the policy action by the Reserve Bank of India, they have slashed the repo rate by 115 basis points and the reverse repo rate by 155 basis points to support languishing growth. Barring the risk of a second wave of infection, the economy on the whole seems poised for a recovery, with macro indicators suggesting a recovery, GDP, and a quote from the RBI policy report that the GDP growth may break out of contraction and turn positive by Q4, that means January, March next year. Now, what we propose to do here is to look at the policy document in terms of some parameters, some important considerations which we have identified and isolated for the sake of easier understanding. If we look at the growth position, the RBI has forecasted a contraction in GDP for the year 2020 of the order of 9.5% with downside risk. GDP growth in FY21 is expected to be negative at 9.2%, 9.8% in Q2, 5.6% negative again in Q3, and positive 0.5% in Q4. That means the January-March quarter next year. But if the current momentum of upturn gains ground, there is certainly a possibility of a faster and stronger rebound. Now let me refer to some Government of India statistics, Ministry of Statistics program implementation, figures which they have put out in public domain, and how have they arrived at a contraction of 22.8%. GDP at constant 2011-12 prices in Q1 is estimated at rupees 26.90 lakh crore as against rupees 35.35 lakh crore in Q1, showing a contraction of 23.9% as compared to 5.32% growth in Q1 of last year. Quarterly gross value added at basic price for 2021 is estimated at rupees 25.53 lakh crore as against 33.08 crore in Q1 of last year. That means a contraction of 22.8%. Now, the Reserve Bank of India monetary policy statement, they have looked at a wide range of data, and it is welcome that the Reserve Bank of India has dissected, analyzed macroeconomic and industry data to demonstrate quite powerfully that the worst is behind us. The RBI's assurances to market participants to undertake further measures to facilitate liquidity and easy finance conditions and provide access to easier credit to small businesses are certainly welcome. Now let us come to the Reserve Bank of India's perception on inflation. There has been a spike in inflation, but the Reserve Bank of India, in its assessment, feels that the current inflation hum is largely transient and inflation could move close to the targeted band of 4% plus minus 2% in Q4. But in the September quarter, it is likely to exceed the tolerance level, the threshold level defined for the Reserve Bank of India at 6.8%. The Reserve Bank of India also visualizes at inflation at about 5.4% to 4.5% for second half of financial year 21 and 4.3% for Q1 of financial year 22, with risks broadly balanced. Subsequently, large favorable base effects could reduce it to 5.4% in Q3 and 4.5% next quarter. These estimates may seem to be overly optimistic, but the September 2020 round of the Reserve Bank of India survey households expected inflation to decline modestly in Q3. This is suggestive of improving supply chains, and the Reserve Bank of India does well to highlight that other surveys apart from this household surveys also conducted in September indicate that consumer confidence is turning upbeat on the general economic situation, employment and income over a 1-year horizon. This is done because the underlying factors are essentially supply shocks, which should reduce with gradual unlocking of the Indian economy, restoring supply chains and normalizing activity. With the economy recovering and supply lines restoring, retail inflation should ease. But in the ultimate analysis, the flattening of the COVID-19 curve continues to be of utmost importance. Going ahead, economic recovery could exhibit a 3-speed recovery process with variations across sectors depending on sector-specific realities. While manufacturing firms may see capacity utilization in Q3, agriculture, consumer goods, power and pharmaceutical sectors are likely to see quicker recovery. The governor's assertion is quite welcome when he said that against all odds we shall strive and revive. In this connection, I'd also like to draw your attention to an important monetary policy report brought out by the Reserve Bank of India on the same day on which the monetary policy presentation was made. And this monetary policy report highlights is that 80% of inflation deviation for target was attributable to food supply shocks and elevated taxes on fuel. Let me come to the issue of liquidity now. Given the large banking system surplus liquidity, the Reserve Bank of India kept bond yields contained through open market operations, OMOs, or Operation Twist. RBI reiterated the non-disruptive conduct of the government borrowing program. OMO amounts were increased to Rs 20,000 crore. RBI's willingness to look through the current phase of high CPI, consumer price index inflation, and future expectation of CPI coming close to the RBI's target should work as a strong anchor for bond yields. The special dispensation for HTM holding held to maturity holding extended till March 2022 with a provision to buy government securities until March 21 and hold these in HTM to 22% of NDTL is welcome. OMO amounts were increased to 20,000 crore per auction. The creative and unconventional announcement of OMO purchase of state development loans will make a state borrowing program non-disruptive, and the cost would also be anchored to broader market realities. Now, there have been a very significant changes in the aspect of retail. The policy permits increased exposure to retail and small borrowers up to Rs 7.5 crore and rationalized risk weights for all new housing loans till March 31, 2022. This will help the real estate sector, particularly borrowers of higher value loans, enhance credit to borrowers and thus generate employment and economic activity. But banks themselves need to be cautious and they need to shore up their credit appraisal processes to reduce the risk of defaults and delinquencies in diverse segments. Another welcome announcement made by the governor relates to the co-lending model to improve credit flow to unserved and underserved sectors. All NBFCs, including housing finance companies, popularly called HFCs, will be allowed to collaborate with banks to undertake priority sector lending. Now, another very important aspect of this October policy is that the LTV norms, loan to value norms, have been revised. The RBI's rationalization of risk weights on home loans till March 31, 2022 will marginally reduce home loan rates and thus boost the sagging fortunes of the housing sector to a limited extent. It would also make available credit for lending. Housing loans for banks are calculated on the basis of the amount of loan disbursed and the percentage of loan against the property value, that is the LTV ratio. Banks will now consider the LTV ratio in computation of the risk weight, and the size of the loan will be rendered inconsequential. All loans, irrespective of the amount, with an LTV of 80% or less will have a risk weight of 35%. Similarly, a risk weight will be 50% for all loans with LTV between 80 and 90%. Now, as all of us are aware, there has been a complete change in terms of digitization of banking products, particularly in the last few years. So here the linked risk weight for home loans to LTVs and making RTGS system a 24/7 payment system on the same lines of NEFT is quite welcome. In December last year, the Reserve Bank of India had made available the NEFT system on a 24/7/365 basis. Another aspect of this policy is its emphasis on exports. The Reserve Bank of India discontinued the system-based automatic caution listing to allow exporters to realize exports proceeds. One aspect of the monetary policy and the banking system which has been considerably debated and discussed in the development discourse is the issue of the transmission mechanism. As I said earlier, even if we look at the position of the RBI benchmark rates from March 2020 onwards to date, the RBI has reduced both the repo rates and the reverse repo rates drastically, but this has not been ultimately transmitted to the ultimate beneficiaries. We tried to look at some of the reasons which could account for this kind of a divergence between the repo rate and the average lending rates of banks. What you find is that there are basically two factors here which explain this divergence. First is the gap between the deterministic RBI repo rate and the borrowing rate of the Indian government, the GSEC yield. And the second is the gap between the GSEC yield and the borrowing rate of individual or private firms. While the latter manifests risk premium in the financial system and inadequate capacity, the former, that is the term premium, can be influenced by RBI's action. One another important aspect of the whole situation is that there is a compelling case for capital infusion, especially in public sector banks. In this context, let me refer briefly to the RBI's working paper on the subject, which was published in October 2020, and the RBI's working paper has cogently argued for capital infusion in public sector banks to enhance real sector credit flow and smoother policy transmission. The thesis that higher NPAs hamper transmission and lower growth rate has been well substantiated in the literature on economic development in general and the transformation of the banking sector in particular. Now let us come to the issue of future rate cuts. Given the expectation of falling inflation in the coming months with a strong kharif crops, brightened Rabi outlook, restored supply chains and resilient rural economy, the incompatibility of a severe GDP contraction with demand side inflation pressures and the RBI maintaining its liquidity support and using several non-interest tools to revive the economy, there could be possibly space for another 25 to 50 basis cuts in this financial year. In our assessment, this rate cut could conceivably occur in February 21, but is certainly possible in December 20. The RBI's assurance of continuing with the accommodative stance in conjunction with liquidity commitments and bond supportive measures will ensure greater policy transmission across diverse markets money market, bond market and bank lending despite unchanged policy rates. Now let us come to our concluding remarks. As all of us are aware, these are trying times. These are times of great challenge, times of great difficulty, a time perhaps like no other in this century. In these trying times have been characterized by macro demand destruction and sluggish investment in India. These aspects necessitate breaching of mandated fiscal levels, remunerative prices for agriculture, cash infusion by public sector, construction intensive activities, and rehabilitation of MSMEs, micro, small and medium enterprises by an enabling ecosystem, that is timely and adequate credit, marketing support and wage cost subsidization. But it is disconcerting to note that there continue to be rising infections in terms of a high number of COVID cases, and the position of state finances also causes some concern. The RBI's assurance to market participants to carry forward the process of liquidity infusion and easy finance condition, provide access to easier credit to smaller businesses are welcome. The RBI's operationally dovish policy would foster development of the broader economy. It is our submission that it would not be entirely appropriate or correct to look at some such measures in isolation or in some kind of a silo, but these measures must be considered an integral part of the measures announced in unison by the Reserve Bank of India and the various stimulus measures announced by the Government of India. The Reserve Bank of India also announced several measures to boost credit growth. Targeted refinancing operations (TLTRO) should help to reduce borrowing rates in targeted industries. Other measures like counter-cyclical changes in risk weights for home loans, higher single borrower limit for small borrowers, and expansion of the co-origination model may have limited impact at the ground level. But it is our submission that the very announcement of these measures shows that the Reserve Bank of India is proactive, is alive and conscious to the evolving situation, and this is again a very welcome manifestation of the kind of proactiveness the Reserve Bank of India has displayed. Unchanged repo rates would help to protect net interest margins, NIMs of banks, since most of the loan book is linked to repo or other floating benchmarks. The policy explicitly recognizes growth risk and consequent need to ensure adequate liquidity. This is clearly manifested in recent measures and the cutoff in auctions. Going ahead, good monsoon, favorable high frequency indicators, pent-up demand and the Oktoberfest of the Navratri festival augur well for the Indian economy. Sometimes, as I said, they are reconciling, there is the issue of reconciling conflicting objectives and trade-offs. This is certainly difficult but doable. The policy remained affordable for governments, corporate borrowers and individuals, and facilitated an enabling ecosystem for larger ground level disbursement of credit both at the corporate and retail levels. The moves to hold bigger auctions for OMO, special OMOs for state government and easier terms for banks' bond portfolios, relief for small borrowers with the threshold exposure limit raised to Rs 7.5 lakh crore from 5 crore are the welcome features. Now, gazing into the crystal ball is always going to be difficult. It is obvious to any well-informed participants of the Indian economic scene that the economic challenges are likely to persist. Financial system still needs some major overhaul and domestic demand is not yet fully recovered. This requires both the Reserve Bank of India and the MPC to stay the course for some more time for a discernible and more sustained improved macroeconomic position. Let me sum up our view. The way we look at the policy is that by holding the benchmark rate, repo rate steady in the face of evolving growth and inflation concerns in this era of incipient, uncertain and uneven growth makes this a judicious policy. These are difficult times, but we see light at the end of the tunnel. This too shall pass. We shall overcome. हम होंगे कामयाब. Thank you all very much for staying with us. Thank you very much. Thank you.